Good evening, everyone, and welcome. I'm Tyler Matheson. Susie Garib is off tonight. Well, no time for panic or even a double cocktail, but stocks aren't exactly off to a great start so far this year. Day two in the markets, day two of declines for the S&P 500, the first such two-day losing streak to begin a year since 2005. Yes, the losses today were minuscule for the S&P, fractional in fact, but losses they were on this mixed and chilly day on Wall Street. The Dow did manage a small gain. Stocks rallied a bit around midday as traders watched outgoing Fed Chairman Ben Bernanke give what may be his final big speech before stepping down at month end. Speaking to the American Economic Association in Philadelphia, Bernanke had generally positive things to say about the U.S. economy.
The combination of financial healing, greater balance in the housing market, less fiscal restraint, and of course continued monetary policy accommodation bodes well for U.S. economic growth in coming quarters.
Well, the Bernanke pep talk helped, but wasn't exactly a jolt of Red Bull. Here are today's final numbers. The Dow up, but just a modest 28 points. The Nasdaq was lower by 11, and the S&P was a fraction of a point lower. Well, big blue chip stocks have started the new year haltingly. Dominic Chu reports now on why many market pros are watching, by contrast, small, fast-growing companies even more closely than those suddenly stumbling big company shares.
The skies are getting just a bit darker for some investors. It's not a full-blown storm yet, but many traders are keeping a close eye on one important part of the stock market: small-cap stocks. They had a rocky start to 2014, and there's a big reason why investors care. They're considered by many experts to be leading indicators for the overall market and economy.
Small cap's important because small cap companies are the largest employer in the U.S. So what they're doing is very reflective of what will be going on in the U.S. employment market, which is obviously critical.
Oftentimes, optimism about the future of the economy leads investors to bet on smaller companies. They're the ones with room to grow. But they're also the ones that get hit the hardest in tough economic times. Since hitting a 52-week high back on December 23rd, small-cap stocks, as measured by the Russell 2000 index, have underperformed the broader market. And add in underperformance on the first day of trading in 2014, and you get why there's worry brewing. But the trend for stocks has been very positive since the depths of the financial crisis back in 2009. So some traders think any pullback could be considered a buying opportunity.
I think the Russell 2000 in 2014 is definitely going higher. I still, the U.S. economy is still the place to play. I think the dollar's going to be strengthening, which means it's going to be good for small cap stocks, especially in the cyclical areas like technology and the industrial names. So I'd be overweight the small cap.
No matter what your view, keep an eye on those small cap stocks. A lot of the professionals are. For Nightly Business Report, I'm Dominic Chu.
Our next guest says that what worked last year for investors won't work this year. He's Joe Duran, CEO of United Capital Financial Advisors. Joe, welcome. Good to have you with us. Before I get your answer to why you say things that worked last year won't necessarily this year, let me get your overall take on how you see the U.S. economy in 2014. Chairman Bernanke said he thinks it's getting better. Do you?
I totally agree. I think we've seen a very nice recovery, especially the back end of the year. And it's broadening, and the Fed hinting at tapering is also telling us that they're seeing things that we're not yet seeing, which makes me feel very optimistic about the economy and a broader and stronger recovery, maybe even over 3% and approaching 4% for this coming year, which is quite encouraging.
That is a bullish forecast. Now let's talk a little bit about why you say that what worked so well in 2013 may not or won't in 2014. What specifically are you referring to and why?
Well, I think two things. First, it's historical that people will typically crowd at the beginning of the year to the things that worked very well last year. But the market is a living organism, and it changes with time. So what you had for most of last year was a very stagnant and very slow and disappointing recovery. And in times like that, people pay up for high growth, high revenue growing companies. You saw that with Tesla and Apple for a while, like very high growth, high octane Netflix. They get a premium. When the broad economy starts to grow even more, it changes, and people then shift to more industrial names, less exciting names like General Electric or United Technologies that provide infrastructure, because it lifts all boats when you get a high-growing economy. And so the larger, not so exciting names often do better than in the early stages as we saw last year. So I think what you'll see is a shift from the very well-known top-line growers to more stodgy, more boring companies this coming year, which frankly is not bad because you don't want to invest in last year's winners always.
You really seem to be saying that it's not a year so much maybe for speculation and betting on fast growers, but more a year to be betting on underlying economic growth and earnings per share growth.
And the reason you want to do that in a time when the market's already recovered as much as it has, remember, we've had a 30% year. That's really big. And so you have more speculation in the market than you had before, and you don't want to do with the most dangerous times in the markets are when nobody sees risk. And we're approaching that now. People are very complacent. They feel very good. And so you want to become a little bit more conservative when everyone becomes a lot more aggressive. And so what we're saying is be more selective, invest with stocks that have not doubled or tripled in the last 18 months, and be safe.
Very quick thought. You think that we are overdue for some sharp pullbacks in 2014. How sharp, and why do you say that?
Well, it's very unusual to go through 6 quarters where you do not have a 10% decline. Historical averages, every 18 months, you have 2 10% declines. We've not had that for 18 months now. And people have become very complacent. So I think the first pullback we have, which could be caused by almost anything, while not a reason to sell, will be a cause for a lot of new investors to get nervous once again. And so the first decline will probably be a 10 to 15% decline. And we think very likely to happen in the next 6 to 9 months simply because it's been so long since we've had one.
Right.
And the longer we go without one, the sharper the decline is likely to be and the more scary the first drop will be.
We have to leave it there, Joe. Happy New Year from beautiful Irvine, California, here in snowy New Jersey. Joe Duran, CEO of United Capital Financial Advisors.